Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Pekko and my partner, Hari.
Hello.
How are you guys? Hope you guys are doing well. In this episode, we're going to be talking about Joel Greenblatt and his magic formula. We talked about it in the previous episode when it came to Spinoffs. We talked in detail about who he was, who he is, what his kind of philosophy is in terms of the special situations, and in particular, spinoff. And in this episode, we're going to cover another dimension of his strategy, which is called the Magic Formula. He wrote a book that talks about this. Hari, do you want to show it to our audience?
Yeah.
There we go.
It's called The Little Book That Beats the Market, and he had a follow-up to it called Little Book That Still Beats the Market. So they are two different books, but both worth reading and can be picked up fairly cheaply on used or on Amazon or buy it new.
Yeah, exactly. I read them both. Highly recommend anybody who is interested in investing to take a look at these books. And there are a lot of actually good speeches and interviews that was done online on YouTube. So go check them out. Just Google Joel Greenblatt Value Investor. You'll be able to find a ton of information out in the internet. But again, in this episode, we're going to be talking about specifically his magic formula. Now, it's a formula that he built, and he describes it in his book. And we're going to do a deep dive into that. So actually, before we do, Hari, could you give us a disclaimer?
Yeah. So this podcast, the Value Investor TV podcast, is here to educate and entertain you on the concepts that are behind value investing. If you are making investment decisions, and please consult with a financial advisor before doing so. We are not financial advisors, and we don't know your individual situation.
Yeah. So don't rely on us to make financial decisions. Definitely consult your financial advisors. All right. Let's get into this, Hari. Do you want to tell us a little bit about the formula itself, why it's so important, what it is, etc.?
Yeah, it may be worthwhile to just kind of tell everyone, in case they had forgotten or they missed the spin-off episode, just tell us a little bit about Joel Greenblatt and his chops as an investor. Yeah,
for sure. Joel Greenblatt, he runs Gotham Investment. It's an investment very value focused investment fund. He's also an adjunct professor at Columbia. He teaches course on value investing. He is one of the heavy hitters in value investing world. So in the value investing world, obviously the big hitter, Warren Buffett is the oracle himself. You got Joel Greenblatt. You have many other guys in the field, but Joel Greenblatt is one of the big names in value investing community, and that's because his number speaks for itself. For the last 20, 30 years, his return has been 40% on average, compounded annual growth rate of 40%. So his number speaks for itself. It speaks to the power of compounding investment strategy. And if you take a look at how does he invest, the question is, what is his specific flavor of value investing? He's really into special situations. So we talked about that just now. Special situations are, for example, if a company is going through bankruptcy, is there an asset that you could pick up that are undervalued? That's one strategy. Another strategy is what we just talked about. Excuse me, which is a spinoff. What that is when a company gets too big, and let's say a company is involved in building cameras, and one of their subsidiary is involved in building, for example, car parts. It's a two different business altogether, but they happen to be under one company. What they will do is they will spin off one of the companies as an independent entity. So that's called spinoff, and there's a lot of elements at play when a subsidiary is spun off. When a subsidiary is spun off, and it lends itself nicely to value investing play, because there are elements at play that really forces the price of the subsidiary or the parent company to go down. So it's a fertile ground to look. And Joel Greenblatt, among others, have been really championing this strategy. So going back to your question, Hari, excuse me. Yeah, Joel Greenblatt, again, he's a really big name value investor, and those are some of the areas that he really champions. And today we're going to be talking about another aspect of his strategy, which is Magic Formula.
Yeah, and I think it's kind of important to understand that with Greenblatt, he was trying to focus on companies that were selling for a good price. And we're also selling, as a good business, right? And so the idea behind, what Greenblatt is doing is, he's marrying the best of both worlds, right? He's taking a company that has that is cheap and is good, right? So in, the kind of Benjamin Graham kind of philosophy where it was, trying to buy a company that was super cheap based on assets, a net or, companies that were trading basically for less than their entire working capital and current assets. That kind of company is not, something that you find very often anymore. And so what Greenblatt really was trying to help elucidate with this is, and there are actually a lot of other investors who kind of follow this, but, finding a company that is not only is cheap, but is also has a high return on capital. That's how he defines a good business, right? And the idea behind that is, we had talked about a couple episodes ago GameStop, right? And we had seen a business that had a very good asset, had a strong balance sheet, but there were earnings were kind of slowly eroding. The company's in an industry that's not working out so well. And the problem with using their, assessing it based on their balance sheet is that the company may engage in, trying to resurrect itself and burn all of its available capital in doing so, right? So trying to turn around a business is not necessarily an easy thing to do. So when you're trying to buy, what we're trying to find is good companies, so companies that aren't what we saw in GameStop, which was a value trap. And so we have a good business, but we also don't want to pay too much for that, right? And I think it's a very powerful concept, because essentially this, we're in, almost 70 episodes into the podcast. We've basically talked about that entire concept this whole time, right? Is we want to buy good companies. That's why we have a checklist to identify what are the pitfalls with those companies. And we want to buy them cheaply, right? We want a significant margin of safety before we'll purchase. So the same concept that Greenblatt is applying here, he has distilled it down to two formulas that actually cover a lot of stuff. Now, we'll talk about what he does in the book, and then we'll kind of talk about how we actually think he uses this in real life, right? Because I think he still uses the same formulas to pick his stocks, right? He kind of uses this to screen what businesses are available to him, what are good stocks that are cheap, and then he filters it down even further by doing the analysis, going through his checklist if he uses one, and then so we're proposing this concept as a way to identify good businesses that are cheap, for then you all to then start using that as not as the end list of companies to buy, but as a starting point for companies that you would want to investigate and then purchase for your own portfolio. So
to look further.
Yeah. So let's get started with that. And if you are not familiar with some of the terms that we're going to use, because we're going to talk a lot about financial statements in this episode, I highly encourage you to go back to our episode talking about financial statements. We're going to be looking at all three of them to some extent here. So the income statement, the balance sheet, and the cash flow. So if you want to listen to those episodes before going forward, I'd highly recommend it. That way you're not lost as we're talking through this.
Mm-hmm.
Okay, so let's get into the discussion around, and before we give you all of the formulas, let's just talk about the components that go into the formula. So he uses EBIT, which is earnings before interest and taxes, as a measure to identify for how much money the company is making, right? And the idea is that if a company is highly leveraged, it may have a lot of interest payments. It may have a tax structure that is not necessarily tied to, it may be different if they were in a different area or a different region, or if, there is a federal government change in the tax code, that'll impact it. So what he looked for was using EBIT. And the idea is that he's actually really trying to find a more normalized value for cash flow, right? So what I've seen him talk about is actually free cash flow as in EBITDA minus the maintenance capital expenditures. So in a company that's got a lot of, is kind of a normalized business, they've been operating for a long time, EBIT and free cash flow will kind of mirror each other in some, they will track each other as businesses go. But he says stick to EBIT because EBIT is a good number that you can rely upon across businesses, right? The other thing is that this formula does not apply to financial companies, so banks and insurance companies, you should kind of stay away from those. Because they would not really apply here because their structure is slightly different than what he's doing. So EBIT will be used in both parts of the equation. And then he uses enterprise value. So we've probably mentioned enterprise value before. So the market cap of a company is the number of shares outstanding times the price. That's usually diluted shares outstanding. So that gives you the market cap. So diluted is even with the options available, the potential shares that could be available. And then you actually add in the long-term debt, the total debt to the company as well. So what you're trying to do is what does this company make, EBIT, and relative to its enterprise value, right? And the reason that we want to do it that way is if you see a company that's made a lousy bet because they've leveraged up debt-wise, right? If they have a high amount of debt, well, that will actually lower their earnings yield, right? So look at price to earnings ratio, right? If you have the price to earnings ratio, that is price over earnings per share, right? That is the net income divided by the shares outstanding, gives you the earnings per share, and then the price is the other side of the house, right? But the price doesn't take into account what is the debt that is loaded up on the balance sheet, right? So if you were to buy this company outright, you would have to buy the company plus pay off its debt, and right, that's how the concept behind enterprise value.
Yep. So
he takes that into what he calls earnings yield, right, which is EBIT divided by enterprise value. So if you take those two numbers, EBIT divided by enterprise value, you get an earnings yield, which is in some ways the inverse of the price to earnings ratio, but it's using a different, two different measurements there. But it's also important, like we talked about with maintenance CapEx and other things, to use the normalized EBIT, right? So you don't want to, if a company has one good year or one bad year, it's affected by one-off expenses, things like that. You want it to be normalized across the EBIT, right? So you want it to be something that you can rely upon as this is how much they actually would have earned in a normalized situation. So Becco, any comments there on the earnings yield?
I just I think we should have done maybe a better job at explaining what Magic Formula, kind of the purpose of Magic Formula is. I think you touched on it briefly, but I want to emphasize this. Magic Formula, Joel Greenblatt put together this formula obviously for his own investment purposes, for his own investment practice, but also for everyone else to look at. So he actually has a website that screens out, that filters out companies based on this formula. And so this formula, what it is it's just a combination of how efficient the company is. So we classically look at return on equity. So it's just a little modified versions of what we usually look at to filter out companies for himself, but also for everyone else in the wild, in the investment community, to look at, to find good investment. Again, this is, basically he's just funneling down, there's like 6,000 publicly traded companies or something like that in the US alone.
Yep.
What he's doing is he's using this formula to filter out 6,000 companies to a manageable number, for example, 50 or 100. And then, like Hari said, we can go through those 50 and 100 and take a look at them more closely. Yeah. And so what this is doing is basically that filter.
Right. So we will talk about what those cutoffs will be in a little bit, like, what are good numbers to use. Mm-hmm. But, so just going back to that, the earnings yield, right? Mm-hmm. The inverse of the price to earnings ratio, but using more specific numbers, so EBIT and enterprise value, you kind of see how much, if I were to buy this entire company, pay off all of its debt, right? That's the amount of cash that I would have to outlay if I were owning this business. Mm-hmm. What would my yield be on, how much money would it generate per year? Right. Mm-hmm. And if you look at, some of these companies that are, tech companies that are trading at 30 times earnings, right? Their earnings yield, the inverse, assuming they had no debt, right, would be around 2 or 3%.
Because the enterprise value would be so high. Yeah,
because the enterprise value is high relative to how much they earn, right? And so if conversely, a company that has a PE of 10, right? You invert that, that'll give you assuming also no debt, earnings yield would be about 10%, right? Mm-hmm. So you look at companies like that, and imagine that means that if the company never grew its earnings, in 10 years you would pay off your purchase price plus the debt, mm-hmm. right?
Yep.
Which is another way of thinking about this, is how quickly do I pay it off?
Yeah.
So, to give you an idea of what that is in, like, say, a real estate market, real estate, a 10 cap, right, is the capitalization rate. 10 cap is, you'd get about a 10% a year is considered a really good return, right, for a business, right? And that would correspond to a PE of roughly 10, right? Mm-hmm. Private businesses can go for about a PE of 7 or 8. Right, which is an earnings yield of 12%. So I'm throwing these numbers out there because what we are trying to get you to look at is when you look at any of the investments that you may be going through regularly, there's other ways of thinking about how much money are you earning on your business, right? And this is just no different than any of those things. PE, price to free cash flow. He's using enterprise value because it takes into account how much you would have to pay off for debt, which is, I think, a very good way to think about it, right?
I think so as well. If I could just add a comment there, Hari, I think a lot of people forget about, people look at market capitalization and that's it. But in reality, that's much more than that. You have to take into account debt.
Yeah.
And so enterprise value, I think, really shines light on that aspect. Another comment that I want to make is, you talked about the efficiency, like the investment yield. Yeah. I think a good way to think about that is, I think about like a car. You have a car that can go 100 miles per gallon versus you have a car that can go 10 miles per gallon. You want, obviously, everything aside, stylistic things aside, cultural things aside, you want a car that can go as far as you can with minimal amount of gas as possible.
Right.
So I think about it in a very similar term. Excuse me, with companies. If a company can generate, $100 million with $1 billion base capital, that's 10%. But if a company can generate, let's say, $500 million with a base capital of $1 billion, that's 50%. You want that. You want the latter.
Right.
You know, I think about this concept. It's very similar to gas per mile with cars.
Yeah, and so that is a good transition into the second part of the formula, right? Which is what Becco is kind of alluding to there is the return on the capital, right? Return on how much you put in. So, you know, the first one is how much you pay for the entire business. How much does it earn? This is the same thing. We still use EBIT here also. But EBIT will now be, so EBIT is the numerator for both of the formulas, but the denominator is actually similar to what we do when we talk about, return on equity or return on capital. This is actually return on capital employed is another way to look at this, right? And so return on capital employed, you know, there are a lot of these formulas, and I think the terminology is not necessarily standardized. So you may hear this, but you know, used with return on capital with different things. There's return on invested capital, return on tangible capital. So this may fall under the return on tangible capital also. So the formula, though, is for the denominator is net working capital, which is the current assets minus current liabilities, plus the net fixed assets. So that is your, you know, these are long-term assets that you have in a business. So net fixed assets are, you know, purchase of property, plant, and equipment is probably where you would see that on the balance sheet, property, plant, and equipment rather, minus any depreciation that the business has accumulated, which is the net fixed part of it, or the net fixed assets. Yeah. So there's another way.
Could you repeat that for us one more time, that denominator?
So net working capital is the current assets minus current liabilities plus the net fixed assets, which is which is property, plant, and equipment, net of any depreciation that is encountered on there, right? So let's think about what they're actually trying to tell you there, right? Mm-hmm. Is like, forgetting the formula for just a second, if I were to take this money that I have in the business, how much is it going to return to me, for my investment, right? So we're not talking about businesses, like we're not looking at how much cash is in the bank. Would be included in a return on equity formula. We are not looking at intangible assets like goodwill, right? We are talking about assets that are actually used in the day-to-day operations of the business, right? Mm-hmm. The equipment, the trucks, the physical infrastructure that's required for that, and then any current assets, which are things that'll be turned into cash, accounts receivable, inventory, minus any current liabilities, right? So those are accounts payable, and the current liabilities also includes any part of the working, of the long-term debt that is due this year. So the idea here is that you're trying to.
So hold on a second.
Yeah.
So the long-term liability is included, you said?
No, it is only the current portion of the long-term liabilities.
Okay.
So
the long-term liability is not included in this formula.
Correct. Okay, so the idea here is only the things that we will be using on the day-to-day basis will affect this company, right? Mm-hmm. So there's another way of getting to this formula, which is before I move on. So net working capital and net fixed assets. So if you look in there, if you break down that working capital, you will also see that we have in the current assets, we will have cash, right? So we want to take out any cash that is excess to running of the business, okay? Mm-hmm. Some people will say all cash is excess. Some people will say, only a small percentage of it, should be removed because you still need cash as part of paying your bills and that kind of stuff, right? Mm-hmm. So, one way to do this is to say anything that's above like a small percentage of the working capital. So like anything that's above like 10% of working capital that's in cash, you remove from that. So, I mean, if it makes it easier, you can just remove all of the cash from the equation, especially for large, businesses that generate a lot of cash. Think about tech companies. They have a lot of cash on the balance sheet. You're removing this excess cash because cash is not necessarily used in the day-to-day operations of the business, right? The company is making a product or selling a service. They're not using the cash as they're not loaning the cash out as part of their day-to-day operations, right? They may be doing so on a financial basis, but not on a standard operating. So that includes any short-term investments. You would also want to remove those, right, if they put it into treasury bills.
So if I could maybe summarize that point really quick.
Yeah.
So really at the end of the day, what we want to get out of this denominator is we want to come to a number, an asset base that company uses to run the company. So for example, cash that is not the cash that is not part of running the company is excluded from this.
Right.
Also, a long-term liability that is not part of running the company is excluded from this as well.
Correct.
So you're looking at working asset plus fixed asset minus the depreciation and also minus the current portion of the liability.
Right.
Is that correct? Sorry.
Correct. And you want to take out any excess cash, as you mentioned there. There's another way of also looking at this, and if it's helpful for you, you can do so. Think about it this way. You can take the total assets of the business, and you can also start subtracting out the current liabilities and subtract out intangibles like goodwill, and then subtract out excess cash, right? You will effectively get to a similar number by doing so.
Could you repeat that again for our listeners?
Yeah, so taking the total assets, subtracting out current liabilities, right? So that is not any different than what we're doing, right? I'm getting to the same formula. I'm just now doing it a different way, right? I'm now subtracting out intangibles. So goodwill, these are tangible things like goodwill and patents, those kind of things that are on the balance sheet that were purchased from another company. And I'm taking out the excess cash. So I'm left with the same formula, right? Net working capital plus net fixed assets. Okay? So the reason that we don't include goodwill in that is goodwill is a historic cost, right? As part of my day-to-day business, I am not paying that cost every day, right? I'm not using that as part of the operations of the business, right? That was a historical cost. It's not an ongoing thing. So if I'm going to throw out something here, if you are more interested in learning this, Berkshire Hathaway, Warren Buffett writes letters. In 1983, he wrote a letter explaining why he doesn't include goodwill in the in his measurement of return on capital, right? And it's a good letter to understand why goodwill is not... It's there on the balance sheet, it's there for a reason, but it doesn't necessarily help you understand how profitable the business is because goodwill is not useful there. I want to also emphasize that what you were finding with these magic formula companies is you're typically finding asset-light businesses, right? So if we look at the denominator again, current assets minus current liabilities plus the net fixed assets, right? So net fixed assets are buildings and things like that. If you are a software company, you don't have a lot of net fixed assets, right? You don't need a lot of trucks and equipment and shipping containers and things like that to do part of your business, right? So if the denominator is smaller, then your return on capital is higher, right? So we would look at businesses that are in the service industry. Think of like tech consulting company like Accenture, or a software company like Microsoft. Those companies will appear on the screen frequently because they have very light business, assets relative to their working of their business.
Yeah. Could I just mention this really quick?
Yeah.
maybe a good point to summarize what we said here.
Yeah.
So Hari, you mentioned two formulas. So really it's like a quotient. It's just a quotient. Yeah. So the first quotient that you mentioned was you have the EBIT, which is a measurement of the return of your money, divided by your enterprise value.
Right.
So that was the first formula. The second formula is same numerator, EBIT, which is just, again, a measurement of your earnings, divided by capital employed.
Yeah.
So capital employed. So we talked about that formula, adding in working capital, adding in fixed capital, and subtracting non-performing, non-essential assets such as cash out of that denominator.
Right.
So I just wanted to point that out. That's at high level. We were talking about two different formulas here. One, like I said, was EBIT divided by enterprise value, and the second one is EBIT divided by capital employed.
Yep. All right.
Just wanted to summarize that for our listeners.
Yeah. So simpler, the formula itself is not that complicated, right? And, I think, it's a very powerful formula because, what he is looking for is businesses that have a very high return on capital but are trading at a very cheap price. So if you just get those two things right, you've eliminated, a ton of companies that are, maybe they're cheap, but they're also lousy businesses, right? Or maybe they are good businesses in terms of, but they're not trading for a cheap price, right? So you merge the two concepts together. And, I think in Greenblatt's book, he talked about the return on those as 25+% per year, 25 to 30% per year. And, he has also mentioned that, 1 out of 4 years, it doesn't really work all that well. But in the years that it does succeed, it really, you don't need too many times earning 25% a year to make a lot of money, right? And
exactly.
You do that a few times and, over time that will, you'll compound your money 10x every 10 years, around 25%. So that's a fantastic return.
Yeah, it's a great return. I want to encapsulate what you said earlier, Hari, which is, as value investors, we look for good companies. We look for cheap companies that are good, right?
Yep.
So those are two different yardsticks, good companies and a cheap company, two different yardsticks. And effectively, Joel Greenblatt, by introducing these two formulas, he's effectively saying these two formulas correspond to good and then the other one correspond to cheap.
Yep.
So the first formula is cheap, is to figuring out the cheap, and the second formula is to figure out good. And we'll talk more in detail about that in the next episode.
Yeah, I think we can kind of walk through how you would use this in practice to screen for companies, how we think Greenblatt does it based on what we've read over the years. So, we'll look forward to explaining that in the next episode.
Awesome. Anything else you want to add before we close out this one?
No, I think in the past we've kind of talked about the checklist. If you want to communicate with us, or if you have any questions about what we talked about today, or you want a copy of the checklist, you can email us at info@valueinvestor.org or tweet at us at valueinvestortv. And those are good ways to get a hold of us. We have a lot of people asking questions. We're happy to answer and happy to get any feedback on the podcast. So
awesome.
Please email.
Awesome. Thank you, guys. We'll see you on the next episode. Thanks.
Thanks.